Hello, welcome listeners and market participants. Thank you for joining KBRA's European Credit Podcast, Conversations in European Credit. I am Gordon Kerr, Head of European Research at KBRA, and today I am joined by an external individual by the name of Fabio Di Giansante, Head of Large Cap European Equities in Amundi.
Hello, Gordon. Hello, everybody. Thank you very much for having me today.
As well as my colleague from the corporates team here at KBRA, Karim Nassif.
Hello, Gordon.
For those of you that don't know, Amundi is the largest asset management firm in Europe with over 2 trillion in assets under management. And today we are going to hear some insight from Fabio discussing the corporate European market. Despite the increasing likelihood of a recession in Europe, owing to the impact of inflation and rapid rate rises, companies are continuing to produce, which suggests potential for soft landing. Economists are regularly pushing out the timing of any sort of a slowdown. This is partly because corporate profitability in aggregate has been more robust in many sectors across Europe than originally assumed. However, the impact of higher interest rates for longer is starting to bite, with margins and corporate production in Europe showing signs of a slowdown. This is likely to have a greater impact on the non-investment grade corporate market, particularly those with floating rate exposure. We wanted to explore this report in greater detail with my colleague Karim, as well as our external guest, Fabio. Let's start off with you, Karim. What are you really seeing in terms of the development of the corporate earnings market recently?
Yeah, thanks, Gord. So I think the first thing I would highlight is that although the publicly listed corporate EBITDA margins have been recovering post-pandemic, they have more recently started to temper. Of course, this varies sector by sector. This is occurring as input costs continue to rise with inflationary influences throughout the supply chain, in combination with limited consumer capacity to absorb these price increases. Other indicators are also pointing to weakening market prospects for corporates. For example, if you look at industrial production, that's been on a downward trend since late 2022, as the impact of economic events begin to take hold. Also, European economies have experienced a negative trend in terms of revenue trajectory in the retail sector since inflation began to increase at the end of 2021 and into early 2022. Now, despite these pressures, the strong profitability witnessed in recent years has meant that many of the larger publicly listed corporates in Europe are actually well positioned for the challenges ahead as they deal with these higher financing costs. We do see some sectors as particularly exposed. For example, real estate and construction, heavy industrial, technology, and really sectors that are exposed to consumer spending. These we do have a particular close watch in terms of how their profitability is going to evolve. As rates have increased, so has the divergence between the cost of financing for higher quality credits versus lower quality credits. As a result, many companies with already challenging business profiles are likely to face a proportionately higher cost of financing going forward. So as you said, Gordon, in the introduction, we consider a particularly challenging time ahead for the lower quality credits, typically non-investment grade, which tend to have more floating exposure and more exposure to shorter-term refinancing risk. Overall, we expect, as you say, a potential soft landing marked by more defaults on the spec side, but relative insulation for higher quality credits if these conditions persist.
Thank you very much, Karim. So, Fabio, turning to you, given we're likely to see this higher for longer environment in 2024, though inflation has been showing some strong progress, how do you see corporate performance developing across the sectors that you cover in 2024?
Thanks, Gordon. Yeah, in the scenario of higher or for longer rate environment, we are actually seeing, we can foresee the risk of impacting both the top line level and margins for corporates in general. Obviously, there will be different degrees according to different business models in different sectors. We've already been seeing the signs of consumer weaknesses. That's very evident in US, where the savings ratio have declined from 7% to 3%, and is affecting mostly the lower cohort of income brackets. The pressure doesn't seem to abate. It actually seems to be increasing when you listen to corporates talking more recently during the Q3 reporting season. And it looks like that also the European consumer seems to be affected. The situation in Europe is a bit better in terms of saving ratio because we haven't spent all the money that we saved during COVID, different from US people, but the uncertainty is still very, very elevated. Nonetheless, the employment level is still robust. So we are still not thinking that there is a crisis ahead of us. So in terms of sales picture, we are actually more cautious on discretionary items, mostly in sectors like auto and maybe even in some luxury names as we speak. We see sign of weaknessing trends, and we will continue to see the shift towards lower purchasing tickets from people. So people are moving money from discretionary spending to more affordable stuff. On the other hand, the consumer seems to be still willing to spend on experiences. So some sectors like airlines and hotel, they're still seeing good booking trends, and the pricing is holding up for corporates. On the margin side, in Europe at the moment, we are running at 300 basis points above the pre-COVID level. So during the last year, we have seen a margin expansion overall across all the sectors. And the reason is that every company in every sector has been able to increase pricing, given that their underlying demand has been very strong and has been able to pass through the raw material inflation and the wage pressure that we have seen. Pricing has been the main reason for this margin expansion. And now we are in a scenario where we think you should differentiate between the companies and the sectors where you normally can justify a structural pricing power, and the sectors where this tool has always been used in a cyclical way and as a temporary benefit. So in the first category, I will put sectors like high-end consumer, capital goods, and the technology that are also exposed to some structural themes that are supporting the underlying demand. And in the second basket, the one there where the pricing power is more cyclical rather than structural, I would put again auto, construction, chemical, especially the commodity chemical, and finally also financial.
Thank you very much, Fabio. Now, turning back to you, Karim, rates aren't necessarily the only challenge to markets in the near term. What else do you see challenging European corporates in the year ahead?
So you're right, Gordon. It's not really just about the necessarily the macro environment. The other things that we're watching are energy prices and geopolitics. Now, we expect these to be important themes going forward, also impacting on corporate profitability going forward, depending obviously on the nature of the business and its relative exposure to energy input costs. The recent Israel-Hamas conflict highlights the tenuous stability of energy prices in Europe after the Russia-Ukraine's conflict and its impact that was observed last year. Now, we saw obviously significant swings in oil and gas prices post the onset of the Russia-Ukraine conflict, which had ramifications for profitability across a spectrum of credits, benefiting some who thrive on volatility, such as, for example, commodity traders, and some commodity producers, but impacting the energy-dependent corporates or corporates who struggle to pass on the sporadic increases in these energy costs. Now, since the onset of the Israel-Hamas war, there has also been volatility, but the oil price has generally since stabilized and remained range-bound, mostly around $80. The TTF gas prices have also been broadly in the 35 to 50 range since the onset of the Israel-Hamas war. However, tail risks such as material escalation of geopolitical conflict in Russia-Ukraine or expansion of the Middle East conflict leading to sort of more extreme scenarios, such as, for example, shutting the Straits of Hormuz, could impact supply chains more materially and lead to more pronounced and dramatic impacts on energy prices. Aside from the effects of war, decisions by key cartels such as OPEC on energy supplies, as well as the economic fortunes of key energy importers and players in the energy space, such as China, can also impact the energy supply-demand balance and ultimately energy prices. In short, while prices are currently range-bound and certainly lower than post the Russia-Ukraine shock, we expect volatility to remain the prevailing theme around energy prices.
Thank you, Karim. That is interesting, in particular, focusing on the energy space. Turning to you, Fabio, what impact, in your view, will policy initiatives such as the EU reform plan and agenda for energy transition have in providing change in the dynamic with regards to corporate performance in spite of the subdued economic environment?
So those kind of fiscal policies have been clearly a great support in the last couple of years. And we foresee they're going to continue to be, for the foreseeable future, generally speaking, a good support for European corporates. We are not only talking about EU support, we're also talking about all the acts that have been started to be implemented in US. And the evidence is shown by the backlog of some sectors. So if you look at capital goods or even construction in general, they have developed a good backlog, which is supporting resilient top lines and decent margins in the last quarters. For us, it looks like the US plans and US acts, CHIP acts or IRA, looks to be more attractive for European companies. They have the advantage of clarity of the details, and there are clear implementation patterns. So in Europe, differently, the usual issues relate to the fact that those plans need to be approved at single country level. This creates the usual slowdown. We are seeing companies even moving their growth investment capex towards more and more the states. Some companies have even decided to move the primary listing across the pond because being part of the S&P 500 is perceived as a great and an easier advantage to get a better slice of the pie over there. So overall, we will still continue to think that these will represent a good support in 2024, especially because some of this money, or most of this money, hasn't been spent yet. And we think that in an election year like next year, there will be pressure to spend to show so that the economy is more resilient. But also we need to be aware of the fact that governments are running with large debt level and large deficit level. So if we enter in a recession, in a harsher recession or a deep downturn, we struggle to see the possibility for government to do even more in terms of fiscal stimulus.
Thank you very much, Fabio. Do you consider there to be sectors that are more exposed to higher for longer? And are there sectors that are more resilient in the current environment?
Yeah, sure, Gordon. Resilient sectors are the ones that we think show a high level of concentration. So the sectors that are not very much labor intensive, so they can sustain the pressure in terms of wages better. And sectors that are not massively exposed to energy as raw material input. As Karim said before, raw material seems to be stabilizing now, especially on the oil side, but the volatility seems to be with us and seems to be stay with us for longer than expected, especially given the geopolitical environment. So in the category of those resilient sectors, I would put, as I said before, some part of the technology, especially semiconductor and software. Some capital goods, the ones that are exposed to the energy transition. So the companies that are exposed to electrification, renovation, we think they are better exposed. And some high-end consumer, the pure luxury names. The resilience is driven by the fact that they have a high level of gross margin. They are exposed to, as I said, structural trends, and which are going to stay for us for a long time, even if we will have bumps along the roads. And also, I mean, in the case of high-end luxury, unfortunately, in tough environment and tough economic scenarios, normally the inequality gap is something that tends to widen, so favoring, unfortunately, the richer versus the lower part of the income brackets. Those will continue to sustain the spending in the pure luxury stories.
Do you think that investors are discriminating sufficiently between companies involved in the energy transition with sustainable business models compared to those with weaker models?
Yeah, so we discussed at the beginning how the rate environment is impacting consumer. The reality is that the high level of rates has been also in the last 18 months have exposed the weakness in some businesses, more not related to consumer, especially the business where the management have decided to put every bet in a single basket. Some of those businesses were viable before, some of those capex were able to be justified, and the companies were able to leverage up and finance capex at zero rates. But this is not possible anymore, and those companies had to impair most of the assets, and they've been shown in some balance sheet issues, and some of those balance sheets have gone under pressure. In the large cap space, we don't have too many examples of this. There are few in the utility sector, maybe, or in the real estate, but in small and medium enterprises, this is clearly more evident. So we've always been very cautious in terms of our investment approach to leverage. and we will continue to be this way. Quality of balance sheet is one element we will be an important driver of future outperformance in 2024. So the other element for me is also important to consider is to play those structural trends like energy transition, artificial intelligence, and online penetration, for example, through companies that have an established business model, because having an established business model guarantees them the cash flow, which is necessary to finance the growth in the new areas, and thus give them the ability not to, or the necessity to go into the market and to pay higher rates if they have to go into the debt issuance.
Thank you very much, Fabio. That was very insightful. Karim, given Fabio has a focus upon large cap equities, which tend to have higher quality credit profiles, what are your concerns for those companies that have higher degrees of leverage and maybe lower quality credit profiles?
Yeah, Gord. So I think as we discussed earlier, our focus very much is on the spec grade rated issuers. Corporate defaults in Europe have started increasing for these corporate entities with lower credit quality. We are noticing that examples are emerging. For example, group casino loans defaulted in August. There are other examples emerging. In some cases, it's not defaults necessarily, but companies with weaker capital structures in what would normally be perceived as defensive sectors, such as utilities in the case of Thames Water in the UK, or strong business models such as Altice and the telecom sector. These companies with weaker capital structures, weaker credit quality, have experienced varying market distress. So in the case of Thames Water, they had to be bailed out by their shareholders. In the case of the Altice entity, their bonds experienced material price volatility. Both Thames Water and Altice were impacted to varying degrees by the higher cost of credit and inflation, and to their varying ability to pass on higher costs in a timely manner to customers. For us, it's not just about looking at leverage in the absolute sense, but also trying to understand, to what extent the sector itself is essential. Fabio alluded to, the importance that some entities have to play in important sector dynamics and sector trends. In some cases, we see companies that are operating in the energy transition as being essential to the fulfillment of the EU transformation strategy. In our view, there will be considerable incentives placed on the private and public finance sector to support such corporates that are critical to the delivery, for example, of the industrial plan, which Fabio alluded to, and other energy reform plans in Europe. This is notwithstanding that certain historical energy subsidy and support schemes for traditional renewables are being phased out in Europe. So highly levered entities that operate in such environments may be more supported as Europe experiences perhaps a softer economic landing in the coming 6 months or so. Higher levered entities that operate in fragmented markets with material exposure to consumer spending, or corporates that struggle to pass on higher input costs under customer arrangements, or are maybe simply exposed to time lags in being able to pass on those costs, will face a more challenging predicament when it comes to profitability as well as liquidity management. This explains why we may see continued profitability and liquidity challenges and higher defaults demonstrated, particularly among the weaker credits that are spec grade with a less essential role to play in some of these important energy transition dynamics.
Thank you very much, Karim. And of course, thank you very much, Fabio Di Giansante from Amundi. European economies have generally outperformed expectations, helping to contain the potential rise in defaults to date. However, European corporate defaults have started increasing, with a number of high-profile and large credit market participants entering into distressed scenarios, restructurings, and in some cases even default. For example, group casino loans and bonds defaulted in August 2023, and as Karim highlighted, Thames Water in the UK entered into difficult position. Credit deterioration has surfaced at several other companies as the challenges that we have outlined today begin to take hold. Challenges surrounding corporate performance have started emerging that signal more difficult times ahead, with signs of a slowdown in economic performance in industrial production and retail data. As we discussed, defaults are likely to continue to increase in the near term. However, corporates are entering this situation in a broadly positive scenario with high levels of profitability ahead of these challenging times. However, input costs and high interest rates for longer are going to challenge more and more as we progress through 2024. You can find greater detail on our website, kbra.com. Make sure you are registered to receive our latest commentaries and, of course, are subscribed to our podcast. Thank you very much for listening. We look forward to bringing you more conversations in European credit. Best of luck to you all out there.